Germany has been synonymous with economic strength and financial stability for decades, earning it the nickname Germoney in internet memes and global financial circles. Through a robust industrial base, cutting-edge engineering, and export prowess, Germany's economy has been a benchmark of success. It has been the engine that has helped propel the Eurozone through good and bad times alike. However, as the 2020s have shown themselves to be a decade of geopolitical tumult and economic uncertainty, this era of prosperity is now facing unprecedented challenges. As sharp speed limits are imposed on the Autobahn of German economic growth, the question arises, what went wrong with the once mighty German economy? Since reunification in 1990, the German economy went from strength to strength and established itself as the dominant economic force in Europe. Leveraging its strong industrial base, particularly in the automotive and manufacturing sectors, Germany rapidly integrated the formerly socialist Easts, boosting productivity and innovation and harnessing the power of cheaper labor in the former Soviet satellite states. The country's emphasis on high-quality engineering, robust infrastructure, and export-driven strategies turned it into the world's fourth largest economy as German brands like Philips, BMW, and Bayer became known worldwide. As a leading exporter of machinery, vehicles, and chemicals, Germany's economic policies have consistently focused on fiscal prudence and maintaining a trade surplus, solidifying its reputation as an economic powerhouse. However, so bad is Germany's current malaise that the former linchpin of the Eurozone that it threatens to drag down the entire region. The International Monetary Fund, IMF, forecasts that Germany will be the worst performing G7 economy this year, the only one expected to contract. A decline in business activity, lower company expectations, and reduced job creation are all reflected in recent Purchasing Manager Index (PMI) surveys. Germany's economy has struggled since COVID, but its problems have been heavily exacerbated by the Russian invasion of Ukraine. On their X account, Macro 10 showcased the following summary of German economic woes. With a contraction of 0.3% in 2023 and a bleak outlook for 2024, where GDP growth is forecasted at a mere 0.2%. Key sectors, such as construction and manufacturing, have declined since early 2022 and mid-2023, respectively. The former engine of European economic prowess now risks being branded the sick man of Europe. Foreign investment in Germany is also dwindling, and the German Economic Institute reported a net outflow of 1.25 billion euros in direct investments in 2022, the highest ever recorded. High energy costs, driven by the country's green energy policies and exacerbated by the loss of cheap Russian gas, are major factors in this decline. Prominent companies like BASF are relocating investments to countries with lower energy costs, such as the US and China, a country that finds itself in the opposite position to Germany, as it has greatly benefited from new gas deals with Russia since its invasion of Ukraine. Inflation remains a significant issue worldwide, and Germany is no different, with a year-on-year rate of 6.4%, down slightly from 6.5%, and a monthly increase of 0.4%, annualized at 4.9%. Core CPI remains at 5.5%, far above the 2% target, indicating persistent inflationary pressures. In the services sector, the PMI dropped from 47.3 to 52.3, signaling contraction for the first time since December 2022. Meanwhile, manufacturing PMI stands at 39.1, down from 38.8, reflecting declining production across all categories surveyed, and the lowest new orders in 3 years. Factory orders plummeted by 11.7% month-on-month in July, the steepest drop from the COVID lockdowns when the entire economy was put into a coma. The labor market, too, shows a troubling trend with unemployment rising from a post-pandemic low of 5% in April 2022 to 5.7% in August 2023. Job vacancies have decreased from a high of 886,724 in August 2022 to 771,154, stabilizing yet still historically elevated. Consumer sentiment is bleak. with the GfK Consumer Climate Index dropping from negative 25.5 in September. Income expectations have declined, and purchasing plans have deteriorated, indicating a reversal of previous optimism. Consumer spending is down, with retail sales falling by 0.8% month-on-month in July against expectations of a 0.3% rise. Business sentiment is equally pessimistic. The IFO Business Climate Index fell to 85.7, the fourth consecutive decline and the lowest since October 2022. This survey highlights increasing pessimism among German businesses about their current environment and near-term expectations. As economic growth stagnates worldwide, Germany's export-based economy suffers, and recent trade shows exports fell by 0.9% in July, with fragile demand from the UK and China, while imports increased by 1.4%. The real estate sector is struggling, with the house price index down 6.8% year-on-year in Q2, and building permits at the lowest since 2015, a leading indicator of construction activity. The construction PMI is deeply in contraction at 41.5, with house and construction activity falling the most since 2010 in August, and building companies reducing staffing for the 17th straight month. The deindustrialization of Germany is also becoming more visible as energy-intensive firms like Lanxess and BASF have shut down plants to stay competitive. Several long-standing companies, including Eisenberg Erla, Teucer Mineralbrunnen, Karl Rossel GmbH, and Alfred Kraut Lackfenbruck GmbH, have filed for bankruptcy due to high energy costs. Perhaps most strikingly, Germany's oldest metallurgical enterprise, Eisenberg, located in Saxony, which survived 2 world wars, the 30 Years' War and the bubonic plague, went bankrupt in 2023. Geopolitics and demographics compound Germany's economic problems. China, once a major market for German exports, is now a formidable competitor. Western sanctions on Russia, a major automobile market, has both spurred domestic car production in Russia and also heralded the conquest of the country's auto market by Chinese cars, taking over from Germany. Domestically, Germany faces issues such as aging infrastructure, a shrinking workforce, and bureaucratic inefficiencies. These factors hinder the country's ability to remain competitive. Michelin and Goodyear are closing plants, while GEA Group is moving production to Poland. The energy crisis caused by the Ukraine war has left Germany with higher energy costs than other manufacturing economies. Despite these challenges, some small and agile manufacturers remain resilient. However, as reforms stall, the overall outlook remains grim. Finance Minister Christian Lindner acknowledges that Germany is getting poorer due to a lack of growth. Germany's industrial strength was significantly bolstered by its close energy trade relationship with Russia, which provided a substantial portion of its natural gas, oil, and coal. Angela Merkel, a fluent Russian speaker due to her schooling in East Germany, was able to forge good energy deals with Russia. This reliance proved to be a major hindrance when Russia invaded Ukraine in 2022, cutting off Germany's cheap gas supply and triggering an energy crisis. Markus Kreber, CEO of RWE, highlighted that Germany's dependence on liquefied natural gas imports has led to structurally higher gas prices than other European countries, causing long-term damage to its industry. Germany's ambitious Energiewende, energy transition policy, aimed at achieving net zero emissions by 2050, has led to the shutdown of coal and nuclear plants. This transition resulted in Europe's highest power bills, with 1 in 4 Germans now considered energy impoverished. Critics argue that the government's failed transition to green energies, rather than external factors like Putin's war, is to blame for the current economic crisis. In response to the invasion, Germany reduced its gas imports by 32.6% in 2023, mainly by cutting out Russian supply. Despite this reduction, Germany remains heavily dependent on foreign energy, leading to persistent pricing issues. The energy-intensive industries, once the cornerstone of Germany's economic powerhouse, have been particularly hard hit, with significant structural demand destruction expected to continue. The crisis has prompted German businesses to seek opportunities abroad. In 2023, German companies nearly tripled their investments in the US to $15.7 billion, influenced by the US Inflation Reduction Act, IRA, offering strong subsidies. Major car makers like Volkswagen and Mercedes-Benz have increased their commitments in the US, while RWE established RWE Clean Energy with a $15 billion investment in its US operations. Kreber pointed out that while the US has coherent policies to attract manufacturing, Europe lacks the right measures to retain its industries. One of the major issues facing our world today, and a favorite topic of industrialist Elon Musk, is demographics, namely a global population collapse. Globally, the aging population is becoming a critical issue, with those over 65 expected to account for 18% of Asia's population by 2050, up from 8% in 2019, and Germany is no different. According to Moody's, the reduction in labor supply and increased public spending on social care, health, and pensions jeopardize Germany's AAA credit rating. The OECD predicts Germany's old age dependency ratio will rise from 34.8 in 2015 to 63.1 in 2075. Larry Fink, chairman of BlackRock, highlighted aging as a silent crisis in his recent letter to investors, stressing the urgency of addressing it. He noted that declining birth rates in Europe, North America, China, and Japan could lead to smaller working populations and slower income growth. Moody's February report emphasized that aging is Germany's greatest ESG-related credit risk, with labor supply reduction and rising public spending threatening the country's top credit rating. This demographic shift is not unique to Germany. Kathleen Brooks of Minerva Analysis pointed out that global labor supply has grown due to the reintegration of the Eastern European workforce post-Soviet Union, China's rise, and WTO inclusion in 1997, and favorable demographic trends in advanced economies, factors which certainly contributed to Germany's booming years since reunification. However, birth rates are now expected to fall sharply, creating gaps in labor supply, which will hit manufacturing-based economies harder than most. Longer life expectancy and falling birth rates have made Germany one of the fastest aging populations globally. The working age population, 15 to 64 years, decreased from 69% to 64.2% from 2011 to 2021, and is expected to decline further. This demographic shift will have several consequences. A shrinking labor pool will hinder economic growth. Increased pension spending, predicted to rise by 1.9 percentage points by 2050, will strain public finances. Government debt could reach 80% of GDP by 2050, threatening Germany's credit rating. Higher debt levels to fund medical costs and social care are likely across various countries, potentially leading to sovereign rating downgrades and reduced investment both domestically and internationally. Addressing these demographic challenges is crucial for maintaining economic stability and growth. Germany's international competitiveness has shown substantial recovery. The Term of Trade Index, which compares export prices to import prices, is back to pre-energy shock levels. Additionally, Germany's trade surplus reached 4.3% of GDP last year, which is lower than pre-pandemic surpluses, but above the two-decade average and likely to increase this year. There are different opinions. However, the outlook of the IMF is a little less gloomy than others. They believe that concerns about widespread deindustrialization are overstated. While energy-intensive industries like chemicals, metals, and paper have contracted, they account for only 4% of the economy. In contrast, auto production rose by 11% last year, and electric vehicle exports increased by 60%, with companies like Volkswagen and BMW contributing significantly to global electric vehicle sales. German manufacturers are now finding ways to adapt to the energy crisis and supply chain disruptions by focusing on higher value-added products and reducing intermediate inputs. This shift means that manufacturing value added has remained steady despite a decline in industrial production, which means those dire industrial production numbers are a less useful measure of overall economic performance. The IMF also believes that Germany's economic weakness reflects both temporary and structural factors, which can be addressed with the right reforms. Temporarily, high inflation led to reduced customer spending, and the European Central Bank's interest rate hikes to curb inflation, depressed housing construction, and other interest-sensitive sectors. The global shift in demand from manufactured goods to services post-pandemic also negatively impacted Germany's manufacturing-intensive economy. These temporary issues are expected to fade over the next couple of years. Even the more positive outlook from the IMF must concede, however, that Germany's demographic problems will be a major issue going forward. Germany's labor force, which grew due to migrants fleeing regional conflicts, is set to shrink as the migrant wave ends and baby boomers retire. To counter these challenges, the IMF proposed that Germany should increase immigration. More immigrants could help sustain the labor force, though prospects for this are uncertain. Encourage female workforce participation. There are 2.3 million fewer women working than men, and women are 5 times more likely to work part-time. Expanding access to childcare and reducing taxes for secondary earners could help close this gap. Boost public investment. Public investment has been insufficient since the 1990s, placing Germany near the bottom among advanced economies. Enhancing planning capacity and municipalities and potentially easing the debt brake to allow more federal borrowing for investment could improve infrastructure. Cut the red tape. Bureaucratic hurdles hinder investment and business creation. It takes 5 to 6 years to get permission to build an onshore wind farm and 120 days to obtain a business license, both well above the OECD average. Digitalizing government services could speed up these processes, as Germany currently lags behind other EU countries in offering online services to businesses. Germany faces significant economic challenges, but this nation has weathered its fair share of storms, to say the least, and has risen like a phoenix from the ashes many times before.